okay. And cost notes, and there'll be 1 or 2 videos for this session, 1 video from YouTube, something to do with accounting or finance. And then we'll have a learning assessment right at the end of the second module, at the end of the today. And I expect a lot of discussion and interaction, please. All right, you're open for any questions. And basically, I think you've got to just put your buttons of hands up, all right, and then Sheila will manage the rest of it. Okay, so that's really what's happening in terms of the introduction. Okay, module 1. Can you hear me, everybody? Yeah, good. Okay, we will look at objectives of financial reporting, the principles of accounting, and understand what accounting equation is. And then we will sort of simulate a couple of transactions to see what is the impact in respect of the business, and just go through some of the areas of who are the users of financial statements. Now, first thing here is, what is the objective of financial reporting? Is basically for you to make some investment and credit decisions. You make a lot of investment decision, how much of money you want to put in as capital when you start your own business, if you're starting a law firm or whatever. And in terms of credit decisions, the bankers use a lot of this information in order to make sure that they are lending to the right party and the sum which is going to be lent out in terms of loans or whatever. Or even if you go in, have any kind of dealings with any of your customers, you want to make sure that you want to assess the credibility of the customer. All right, so accounting gives you this, and financial reporting helps you to make those decisions. It also gives you an idea of what is your future cash flows going to be. All right, you have some historical information of what's happening to your business in terms of how much of income is coming in, how much of expenses you are incurring. From that, you will be able to assess what is your future cash flows going to be, all based on how much of credit period you are allowing to your customers or your clients in the law practice, and how much is your suppliers giving you in terms of credit. So that will basically, you'll get a basic understanding of what your future cash flows are going to be. And then you want to identify what your assets are, which are your economic resources. What are the claims against those resources? Basically, in every business, there are assets, there are liabilities, all right? So you want to make an assessment, identify what those are at the end of the period or what, all right? So very briefly, this is really what the objective of financial reporting is. Questions? Good to go? Speed of is it fast? Huh?
Yeah, all good.
All good, huh? Okay, okay. I won't put the brakes on then. Okay. So in a business or investment, if you're in law practice, all right, you will be running your business. And what is your ultimate objective is to sell your services, all right, which you charge your fees. At the end of the day, you want to end up making profits. That's really the decision about this. So in order to identify whether you're making a profit or loss in your business and how your profitability is going to be, whether it's your past profitability or your future profitability, financial reporting helps in terms of managing this and giving you an idea where you are heading towards. The first line item in a income statement normally is revenues. Revenues could be you are selling products or you are selling services in the case of your law practice. So that's the first item on your income. So in order to derive your profit, and then you will knock out all your expenses of your business against those revenues, and you will end up, if your revenues are more than your expenses, it's very simply profitability. All right. If your expenses are more than your revenue, very simply, it's a loss. Okay. So it's very fundamental, easy to understand. You don't, this is very logical. It's not really accounting altogether. It's basically logical. The focus of accounting. So what is the focus of accounting? The first thing is to identify what are the transactions which are taking place. You will pay rent. You will receive money from your clients. You will pay your staff salary. You do all this kind of financial transactions. It is identifying this economic event, all right? That's the first stage. The second stage of it is all these economic transactions which comes in a way of different ways, whether it's income or expenses, it will be recorded in the books. And this is recording of the economic events, which is really fundamentally starts from the core of bookkeeping and putting everything into records in your financials, whether it's going to be through a system or whatever, but this is. Finally, once you have recorded, you're not going to be just leaving the records alone. You want to see what's really happening to your business. So you will report and analyze these economic events. So that's the real focus of accounting in a nutshell. Okay. So there are three types of financial statements which are mandated by accounting and financial regulatory authorities or even government authorities or whatever. There are, when you want to submit your tax returns or in terms of your partnership in your firm or your whatever business you have, the first thing is an income statement, very commonly known as a profit and loss account or a profit and loss statement. It measures the amount of profits generated by a firm over a given period of time. When they say it's a given period of time, normally P&Ls, which is called in a short form P&L, it's for a period of time, and most of the period of time generally follows a calendar period of 1st January to 31st December. Everybody likes to coincide this period using the calendar period because the tax period for assessment also falls in the same calendar period. So it makes it easier in terms of having both common. Next thing is in your financials is a balance sheet. A balance sheet provides a snapshot of firm's financial position on a specific date. When you compare with a profit and loss account, a profit and loss account is for a period of time, usually a 12 months period. Okay. Sometimes you want to see how your business is going. You will cut it into 3 months and see the profitability by quarter or by month. But the balance sheet is it shows you the financial state of affairs of a particular company or your partnership or your law firm at a point of time. Usually it'll be the end of the year, which is from 1st January to 31st December is your P&L. On 31st December, you want to see what is your state of affairs. That's how a balance sheet is being reflected. Okay. So you have these two particular statements which are very commonly used and very commonly everybody knows the term generally. Then you have another particular statement, which is known as a cash flow statement. Subsequently, as we get into a bit more on the accounting principles, you will later understand in a company or in a partnership firm, profits does not equal to cash. Neither to loss doesn't equal to cash. All right. So you need to understand in terms of cash flow statement, how did the money come into your business and how did the money get used up in your business? A cash flow statement details this out. So these are the three principal financial statements which are used in all businesses, and it's mandated to be provided for when you, if your company is registered with a registrar of companies or registrar of societies or whatever you call it. So you will have to provide this. But commonly income statement and the balance sheet is the more popular one. A bigger companies use cash flow statement, okay, which is mandated. Good. All right. Any questions? Sheila?
So far, none.
Okay, that's scary.
Okay. It means clear.
Okay, now, so when we prepare all these financial statements, which are your income statement, your balance sheet and all, we are governed by certain principles to be followed by, all right? Certain assumptions to be used in preparing the accounts. And we will be looking at those concepts, which are the fundamental principles of accounting, which needs to be used when you are preparing. If you don't have these ground rules, things will be running in a different way. So these are the fundamental principles to be followed. The first principle to be followed here is the business is accounted separately from its owner, business entity principle. When you are in your law firm, all right, I'm sure in your law firm, your practice or your partnership you have in your law firm, you have a lot of expenses which are incurred, all right? And one of the fundamental things is you need to separate those expenses which are personal to you and the business expense. So Business entity principle is one particular principle. You got to separate the owner or the owners away from the business. So if you have your wife going to, or your husband going to the market to buy some marketing stuff, you can't bring it into your financials in your law firm. All right. So you got to keep all those personal expenses, personal income, everything has to be separated. So that's one particular principle which we need to follow, which is known as the business entity principle. Okay. Objectivity principle. This is very important. Financial statement information is supported by independent and unbiased evidence. When you look at, if you look at any of these accounts which are prepared and published, at the end of the accounts, it is certified by the auditors. And one of the important statements they put down there, this financial statement has been prepared and provides a true and fair view. Have you seen it before? You go to any of the public listed company which is available on the public domain, you can see it true and fair view because it has been prepared independently and with unbiased evidence. You should not have compromised any kind of objectivity, all right? Because it will not be providing objectively the state of affairs of the company, all right? This is very important. And obviously, the tax department wouldn't allow you to do this anything otherwise, okay? Cost principle. That's another particular fundamental concept which we follow when we prepare the financial statements. Financial statements are based on actual costs incurred in the business transaction. How much did you pay to buy the item will be recorded as an expense. For instance, if you buy a particular property, say you buy a property for your business, all right, and it's a business property, you paid 1 million ringgit. That's what you paid for, that's your cost. But the market value of the property could be 1.2 million ringgit, all right? But you are not going to be recording it at the market value because the transactional cost was 1 million. That's what the cost principle says. You got to be recording it at the cost, irrespective of the market value, whether it was higher or lower, you're going to record at what price you paid for it. That's the cost principle. So these are all a couple of principles which govern the preparation of financial statements. Going concern principle. Now, this implies that this company or your partnership, when you prepare an account, you are going to be in operations in the foreseeable future. You're not going to liquidate. It is going to be in existence. Why? If there is any signs that you are not going to be in existence by the end of the year, when you prepare your balance sheet and your profit and loss account, you will be using different values to prepare it for, all right? Say, for instance, I got an example here. In your books, in your financial statement, say you have a motor car with a book value of $80,000 or whatever. But the real market value of the motor car out in the market, if you sell it now, it'll be only fetch $50,000. You will be still using $80,000 because you are a going concern. There is no indication that you're going to close shop. But if there is any indication that you are not a going concern, everything needs to be reflected at the net realizable value of the item or a property.
Mr. Nakulan?
Yeah.
Sorry, I have a question from one of our participants, Sheena. She's asking, what does unbiased information mean?
Unbiased means you are not giving fraudulent information. Those which have, it is not, there's no evidence of the item or whatever being provided for. Like when if accountant prepares something which is not substantiated with documents or receipts or whatever, it could be unbiased evidence of how it's been prepared. That means that it is being prepared with proper documents and evidence of the proof of payments and whatnot.
Okay, and there's another question from Danny, and the question is, what's net realized value? Okay, net realizable value. Net realizable value is, like for instance, in this case, as you're looking at this slide, if in your books, in your balance sheet at the end of the year, you will be reflecting, if you have a motor car for your business, the value of the motor car, book value, later you'll come to something called book value. You'll understand that it is cost minus any depreciation you provided. It is being recorded at 80,000 ringgit.
The net realizable value, if you sell this motor car out in the market in a second-hand dealer, it will only fetch $50,000. That's your net realizable value. That's what it means, net realizable value. Okay, so for this case, the going concern, you will be always reporting it at the book value, not the net realizable value, unless you are deemed to be not a going concern, you're going to liquidate your business, then everything need to be reflected at net realizable value.
Okay.
Okay.
One more. So, on the unbiased information, right? Earlier you mentioned that that would be information that's backed up by documents, right?
Yeah.
So there's a follow-up question from Tina, and she asks, what if the documents are lost? What can you do to provide this unbiased information?
Again, if the documents are lost, it always depends. If your auditors, if I'm an auditor, I will look at the materiality of the amount in the scheme of all things. If your company's business is say 100 million, and if you have a document which is lost and cannot be cited, and you're paid something for 5,000 ringgit, in the scheme of all things, 5,000 is nothing. But if you have something which you have paid for 50,000 ringgit, then you will be having to find a proof to show that what has been, if you don't have the document, you probably got to get acknowledgement for the payment from the recipient of the money or whatever way. You got to find some proof of evidence.
Okay.
Okay.
Right.
All right. So the moral of the story is don't lose your document. Okay.
It's a good moral.
All right. Monetary unit principle. So when we prepare our financial statements, one thing we know, it is not prepared in kilograms or different measurements, kati, or whatever you call it. But it is always in dollars or ringgit. So every event of those transactions is being denominated in monetary units, all right? That's the assumption, always in dollars and cents, nothing else, all right? Money is certainly the root of all evils, but it is also certainly the root of accounting, okay? Revenue recognition principles, which is very, very important to understand. I think last week you guys stressed the point about this, okay? Revenue is recognized when earned, not just when the cash has been received. That's very important to understand. In your practice, all right, you will, when you bill your client, at the time when you bill your client or invoice your client, that's the time you have earned, you have the right to record that particular transaction as an income in your profit and loss account. If your client pays you some deposit, all right, when you take up the case or whatever, the taking of the deposit is not an income. The time income is only earned at the time when you invoice your client, not at the time when the cash is received. So for instance, if you invoice your client 5,000 ringgit today, all right, which is in the month of October, you will record it as an income in the month of October. But your client pays the money only in December, irrespective, you don't record your income in the month of December. You record it in the month of October and knock it off again what your client owes you in the month of December as cash received against that invoice. Very simply. Questions?
Does this apply to, in some law firms, we take like deposits, right? But even before work begins.
Yes.
And then later on, there's interim billing. So I assume the interim billing is when you recognize per bill how much money.
All right. That's why when you collect the deposit, you are just taking an advance from your client, and you don't recognize that advance as an income yet until you start billing your client, or when you invoice your client, because at the same time when you invoice your client, the service tax starts getting triggered too. Okay, in the context of your business.
Okay.
Okay. Matching principle. This is a very important principle, which is quite close to the revenue recognition. Whatever revenues you get in this period, which is being recorded as revenues, should be matched against all expenses related to that particular revenue. A good example here is you bill your clients, all right, during the year. At the end of the year, for the month of December, you have to pay your rental to your landlord. say you had to pay a 5,000 ringgit rental for the month of December, and your accounting period is January to December. At the end of the year, you have not paid the money to your landlord, that 5,000 ringgit of rental, but that expense has been incurred. When it has been incurred, it has to be recorded as an expense, even though it has not been paid, because that is the expense by having that rental and that premises in your, which you enjoyed that use of the premises. It helped you to generate income of billing to your client. That's what you call a matching principle matching, irrespective when you pay the money. These are the fundamental principles of governing the preparation of financial statements.
Okay. So we have a question.
Yeah.
So Sheena asks, what if the person invoice doesn't pay, especially in these times where everyone is delaying payment or have just shut down?
Okay. When you invoice your client, at the time when you invoice, you will record it as an income. Your client pays you after 3 months or 4 months, maybe it's being delayed. When you bill your client, it will become a receivable from your client and it will be recorded as an asset in your books. Subsequently, when the client pays you, you will receive the money and knock it out against a receivable. If your client doesn't pay you in time and you already have you have sent some dunning notice to your client a couple of times and asking for payments, and you have, it shows quite good indication your client might have a situation with himself or her that they are having some financial difficulties, then you will have to be providing for bad debts. That's what happens. But the income will be recorded when it is the invoice generated. Subsequently, when the client doesn't pay you in time or doesn't want to pay you and doesn't have the ability to pay you, and when you tried all ways of trying to recover the money, if you are not able to recover it, then you will be having to write it off as a bad debt and write it off as an expense in your P&L.
Okay.
Okay. Okay, again, a very important emphasis on revenue recognition, one of the principles we talked about. So it should be recognized that revenue in the period it has been earned, business and transaction should only be recorded when the sale has been made or earned. It doesn't say when the money has been received. It is only at the time when you invoice. So in this case down here, you have a situation at the point of sale, which you see here. You at the rate point of sale is the time when you will record your transaction as an income. Not, say for instance, if you are manufacturing things or making products, it is not that time when you make the product you earn the money. It doesn't mean that. Or nor is it at the time when you receive the cash. It is always at the time when the point of sale. At the point of sale, you will actually be recording it as an income. Points to note: when client is invoiced, revenue is recognized not when cash received, but when invoiced. That's something which you got to always remember, all right? It will be recorded at the time when you invoice your client. Similarly, service tax is triggered when the billing is done, not is when you collect the money from your client. By the time you invoice your client, if you are subject to service tax is triggered. Collecting deposit is not revenue recognition. Collecting deposit is a pure form of your client paying you in advance because you want to have assurances that you want to work on this case or whatever. Okay?
Yeah.
Okay, a couple of small bits of things to look at. Some just simple questions. A Rainbow Corporation reports revenue, it's an income statement, when it is earned instead of when the cash is collected. What principle is it? What principle is it?
I can't remember.
Hey, you guys go to court with all the things in your mind. You can what is the principle of not recognizing it when it's earned, but not when it is cash it's received?
Oh, Mr. Nakulan, some way me Tan actually said revenue recognition principle.
All right, excellent. Yeah, okay. Revenue recognition. A business may only report activities on the financial statements that are specifically related to the company's operations, not those activities that affect the owner personally is known as what? You got to separate the business and the owner.
Separate business entity?
Correct. Separate entity concept, all right? Keeping them separate. This is very important, because when it comes to tax, this is very important. Your tax guys will haunt you if you've been charging things which are not related to the business, but you're having parties in your house and stuff like that. You're putting it into your business, okay? So those are very important things.
Like, what if I'm a sole proprietor and I'm having a party as part of my networking?
Yeah, but you know what happens when you have a party, you can call it entertainment expenses, but the revenue department always have certain restrictions on entertainment expenses. Nowadays, the entertainment expenses in terms of tax revenue department is only for your employees.
Oh.
So they have taken out the fact of entertaining clients and this and that and all, because it can turn into a bit of a awkward situation, especially heavy entertainment on clients, right? But even that, sometimes they come back to you and say, there's quite a bit of restriction. They put it at their own discretion. You claim for your petrol and toll in your business, all right? Going from your house to your work and all those things and traveling around, you claim for all those things. The revenue department comes back and says, there is an element of personal use in this. So if you had claimed 10,000 ringgit for your petrol and toll, they might come and tell you that one third of it could be deemed to be personal and 2/3 is for the business. All right. They take this kind of discretion decisions on this kind of things. So you've got to be careful. Okay.
Okay.
When assuming a business will continue to operate in the foreseeable future, what concept is it?
Wavy help.
We are not going to liquidate ourselves. We are going to be there in the foreseeable future operating. Guys?
Going concern. Rajeshri says going concern.
Oh, that's right. Going concern.
Done. Right.
So this is all important, some of the key concepts of accounting. Nikon company reports land on its balance sheet at the amount it paid to acquire, even though the estimated fair market value is greater. So if you record it at the top, what you paid for it, what concept are we using? What is the transaction? What is the actual transaction we took place?
Matching principle.
No.
No.
What is the actual amount you paid for? Is known as what?
Oh, Celestina says cost principle.
Yeah, cost principle. Okay, just a little bit of recap of what we've done. Okay. Okay. I'm sure you would have, a lot of people would have heard somewhere in their lifetime about debits and credits, but we are not going to be talking about debits and credits. We will take a more logical approach of looking at what this whole transactional equation, accounting equation is all about, all right? So at the end of the day, the accounting equation is to drive something to balance, all right? At the end of the day, it is to balance something. So key accounting equation you need to understand is assets. You have assets in the business equals to liabilities plus equity. Equity in this term is owner's capital, your capital which you put into your business, and plus the liabilities gives you asset. This is the fundamental equation of accounting. All right. This is how the whole thing is derived at the end of the day using this concept of assets. There are three key elements in the business: asset, liabilities, and capital. That's the one which structures the whole business. These are all your assets you could have in your business. Cash is an asset. Accounts receivable is the monies you have billed your client or your customer or your client owes you, it is known as receivable. You have office supplies, you have store supplies. If you buy equipment, computers for your business, or if you have a building which is used in your business, your own building or land, or you have prepaid certain things, prepaid expenses in advance you are paid. All these are assets, all right? Any questions on assets?
So far, none.
Okay, liabilities, all right, these are things you hate to have, all right? Accounts payable, all right, you buy a lot of stuff, all right, you buy printer ink, you buy stationery, you buy this, you get some billings from some of your suppliers or what, and you owe your suppliers. That is technically it's called accounts payable. How much is payable to your trade creditors? And then you have many other kind of liabilities. You have tax liabilities to the revenue department, all right? You could be having salaries payable to your staff or bonus payable to your staff, various things of some amount of money payable to courts or whatever, okay? And then you have short-term or long-term loans, all right? Typically, short-term liabilities are if you are funding your business through some means of overdraft. You got bank facilities in terms of bank overdraft. Bank overdraft are deemed to be short-term liabilities because they are revolving. Long-term liabilities are things you would have taken for a longer period. It is things like you would have taken a mortgage or whatever to fund your building or whatever, or any of your assets you have bought. So these are typically liabilities. So you have liabilities, you have assets, then equity. Equity means capital. All right, it is a more of a corporate term which is called equity, but in your term, your language, for your firm, whatever partnership you have in, you will be putting some money into your partnership to start the business. That's known as equity. All right, and you see two arrows here. If you bring money into your business, owner's capital, it will increase your equity. If you bring income into your business by the way of revenue, it will increase your equity. In respect of owner's withdrawal, as partnership accounts you have your business, you draw money out of your business, it will reduce your equity. And the same way, your expenses in your business will reduce your equity. So equity will get reduced by expenses and withdrawal of money from the business, and equity will go up when you put in more money into your business and revenue comes into your business.
Okay.
Clear? So again, coming back to the equation, assets equals to liability plus equity. So you have owner's capital. If you put more money into your business, owner's capital will go up. If you take out money from your business, owner's capital will come down, all right? You see the arrow going down. This is what happens to equity. If you have revenues coming into your business, equity will go up. If you have expenses, equity will go down. So what is the net of revenue minus expense? You either get a profit or a loss. So if you have a profit, equity will go up. If you have a loss, your equity will come down, which is your capital. So your equity is being impacted by all these scenarios down here. So what we'll do next is we will look at every aspect of transaction, very simplified manner of looking at it in a kind of the impact, what it has to assets, liabilities, and equity. Assume you invest or you start a business, your law firm, you put 30,000 in cash to start your business. So when cash comes in, what is cash?
Asset.
All right. What happens to your asset?
Goes up.
What are you starting the asset? What is the cash for?
Capital.
Yeah, equity. Equity goes up. This is Accounting 101, no debits and credit, but really debits and credit are playing here. All right. In reality,
well, Nakulan, you're stressing Sheila out. She's the only one responding.
You guys.
I think she's enjoying herself. Okay. Anybody can answer these questions. I mean, in your business, you purchase furniture paying 10,000 ringgit in cash. So what happens in this case? Some other volunteers?
Asset?
What is furniture?
It's an asset.
So what happens to asset? Asset goes up?
Yes.
Cash, you pay cash,
Liability.
cash goes down. So here, two things happens in assets. Cash is converted into furniture. That's what is really happening. Cash goes down because you're paying cash. Asset goes up because you're buying a furniture. It comes as a furniture, is an asset. You perform consulting services or you charge your client out for some services and you receive 2,000 ringgit, $2,200 in cash. So what is, when you charge consulting services, is it a fee?
Yes.
Is it an income? So
Yes.
what does income does to your items here?
Equity goes up.
Equity goes up, and when you get it in the way of cash, your cash goes up. Okay, so you see, for every action, there is another action or reaction in any of these items, whether it's assets, liability, and equity. All right, two entries takes place. All right, yeah. You paid for rent for January, 1,000 ringgit, and salaries to the business employee, 700 ringgit in cash. So what happens when you do this? Does your cash go down?
Yes.
Yes.
Liabilities, equity down.
Cash goes down. All these are expenses.
Yep.
Yes.
Equity goes down because it's an expense. Revenue drives equity up. Expense reduces equity.
Is the liability affected?
If it has been charged earlier and invoiced out, so what we are saying is, if it has been recorded as an expense earlier, and then now you're being paid for, that's different. But I'm just taking it as the time when you're paying it, it's all being recorded at the same time. But technically, normally, even though it is being paid later, you will be actually recognizing all expenses when it takes place. You're correct with that, okay? You paid $900 to settle accounts payable. So you paid $900. You paid cash $900. So what happens to your asset?
Asset goes down. Equity
And-
goes down.
No.
Liability goes down.
Accounts payable is a creditor. You have already recorded the creditors as an expense before this, and that's why it transformed itself into a creditor. It's a liability. By paying the liability, your liability goes down.
Okay.
Okay. You purchase a motor car for 100,000 on hire purchase. So what comes into your company?
Asset goes up.
Yep.
Liability
Equity goes up as well.
Yep. Excellent. Okay.
Equity, doesn't equity go up?
No, only equity won't go up because you have brought it as an asset to the company and you are buying the asset not by cash. You're buying it and on a HP is your liability. Your equity will get impacted afterwards. What happens to your equity is later it'll get impacted whenever you charge by the way of depreciation into your profit and loss account, which you will see later. Okay. You withdrew cash as a partner in your company or your business. You withdrew 15,000 in cash from your business as drawings. What happens?
Asset goes down
Yeah.
and equity goes down.
Yep, exactly. That's what happens. Because drawings, you are reducing your capital of your firm. Good to go, guys? Yeah. What time is your bedtime normally? 9?
No, we're getting it. We're getting it.
Okay, very good. Okay. All right. So why do you, I mean, this is fundamental principles of accounting. All right. We just wanted to get the core items in accounting and financial reporting. Who are the stakeholders of accounting, all right? Whether you're an owner, the management, or the employees are basically the internal stakeholders who are interested in the financial reports of the company. External stakeholders, government, tax department, you have investors into your company or your partnership. Normally partners are investors, but if you're talking about any other company, there'll be investors, shareholders. Banks are interested, the lenders, suppliers, NGOs, industries, association, rating agencies, like RAM and whatever, researchers, and you got e-talks and all these kind of areas. Everybody is interested in financial reporting. The extent, how much you're going to be preparing it, what is the depth you're going to get into is depending on your size of the company. The difference will be if you're a Sendirian Berhad, you'll be just following the standard requirements by the registrar of companies. But if you're a listed company, you've got a hell of a lot of disclosure requirements, and so much to put it in the public domain, in the newspaper and everything, to publish all your results with so much of disclosure requirements. Okay, because you are being funded by public money. Okay, so these are the users of accounts, financials. That's it.
For module 1?
Yep.
All right.
I know I had to.
And
Okay.
Nakulan, is there a different type of reporting for internal and external stakeholders?
Yes. Internal, normally what they do is, see, for instance, internal accounts are known as management accounts. When it comes to being audited and being reported and being filed with the registrar company, you call it statutory accounts. So management accounts have so much of details in it because you want to make business decisions within the company. You have a hell of a lot of details. But when it comes to statutory accounts, there is the minimum disclosure requirements to meet. You won't get into the very details of it because it's very internal and it might be very confidential to the company. So they might, certain expenses which you have, maybe you got 20 line items of those detail of the expenses, but in statutory account, all of them will be grouped up and called as admin expenses. That's it. What is the real breakdown? You only get in management accounts. So you'll see a difference between, for management reporting, it is more detailed, more for the use of decision making. Statutory accounts is because you've got to file it, and that's what your auditors want to be reporting to. Okay. Okay. So the various stakeholders. Any question till now? We're getting into module 2.
Okay.
Right. Module 2, you'll get into to look at financial statements, explain what a balance sheet is, how do you construct a balance sheet, what is the income statement and statement of cash flow, which we saw earlier, what is the purpose, what are the elements, what is the structure, what is the way you prepare and report it, how does the balance sheet work along with the accounting equation we saw. Accounting equation we saw was assets equal to liabilities plus equity. Do you remember?
Yep.
So what is equity equals to?
Huh? Asset minus liability.
Yay, that's right. All right, that's the accounting equation, how it works. Okay, so define what are assets, liabilities, equity, how are they related? Differentiate between income and cash flow. I told you that earlier. So remember when we looked at the preparation of accounts, we used the revenue recognition method. You will invoice your client. When you invoice your client, you recognize it as an income in your business, irrespective when your client pays the money. So that is a difference between.
Sorry, Sheena has a question and her hand is up. So Sheena wants to ask you directly.
Sure.
Yeah, I'm sorry. I'm really very confused. I don't understand how a liability becomes an asset. You kind of lost me a bit there.
Which one? The earlier one.
Earlier one, right? You said that it's liability plus equity equals asset. How does a liability become an asset?
Which one?
Asset equals liabilities plus equity. But liabilities is what I owe people.
Yeah,
So how is it an asset?
it's not an
How
asset.
does it add up to
Okay,
become an asset?
okay.
Shouldn't it be assets?
Let's put some numbers to it, China. Let's put a number to it. Say your asset is 5.
Yes.
Okay? Liability is 3. Equity is 2. Okay, the equation, fundamental equation. So if your asset is 5, your liability is 3, and your equity is 2. Asset minus liability, which is asset is 5 minus liability 3 equals to 2, which is your equity.
Okay, so can we put it in slightly more concrete terms? Okay.
Okay.
I put 100,000 into my business.
Correct. That's going into equity.
That's equity. Okay. I have bought a bunch of furniture which I need to pay for, say 50,000.
Okay. How did you buy it?
I'm going to pay cash for it.
So what happens? You got cash. You brought 100,000 in cash.
Yeah.
Your capital goes up. Your asset also would have gone up by 100,000. Now what happens is you're going to take the cash and convert it into furniture. So 50,000 goes down in your asset, which is cash, and 50,000 goes up in asset, which is your furniture. There's no impact on liability. Yes. If you have bought the furniture for 50,000 without paying for cash, but took a whatever you took a credit from your creditor for 60 days payment, so it will increase your liability.
Okay, let's say I did that. Okay, I agreed to pay the whole lot in 6 months.
Yeah.
Right. Yeah. So I got 50,000, which is like I'm refurbishing my office, and I spent 50,000 on this, and I will pay this to my contractor in 6 months' time.
Okay.
So I've got a $50,000 liability.
Correct.
Right.
Yep.
Some of that might convert to an asset in the form of furniture, but some of it might just be, stuff.
Okay.
So my liability would be 50,000 then.
Correct.
Would that bring my asset down to 50,000?
No, your asset went up because you bought furniture for how much?
Okay. So the services would be?
Services is not an asset. If you have bought the furniture, furniture is an asset. If you buy services and pay for services, it's an expense. It would have dropped your equity.
Okay, so let's say I'm not buying furniture, right? Let's say I hired a consultant to do a report on something.
Okay.
Okay. And so I'm paying him 50,000.
Correct.
For that report.
Yeah.
Then I've got a $50,000 liability.
Yeah. So your liability will go up, your equity will go down, because you'll charge the consulting fees as an expense to your income statement.
And my asset still remains at 100,000. No.
Your asset will remain under 100,000. Your liability, you're not paid the guy yet.
Okay.
So your liability will go up. Your liability will go up, and your equity will come down.
Okay. All right. Okay. Thank you.
So it is basically a balancing game which is taking place here. All right. So the impact is on liability. So you're funding your company with more liability by charging off that against your capital. Your capital will come down as an expense.
Will the report be considered an asset? Because it's a value.
No. It's an expense.
Oh.
Okay. Thank you.
No problem. Okay. Okay. So what are the types of financial statements, all right, which we looked at earlier? We just briefly went through. One is the income statement, which is typically called a profit and loss account. Then you have a balance sheet and your cash flow statement, all right? So it is basically balance sheet shows your net worth, or what is your financial state of affairs, or your financial health of your company or your business. Income statement shows you whether you are profitable or not profitable. And your cash flow statement shows you where the monies came from and how the monies were spent in your business. So it typically tells you the story. So income statement, all right, which is known as a profit and loss statement, it is for a period of time, all right? It is for a period of time. It could be for 6 months, 3 months. Generally, all financial statements normally, which you're going to be lodging with the registrar companies or whatever, it is for the period of 12 months. A calendar period normally is being used because Malaysia uses a tax calendar period. Countries like UK, their fiscal year is from 1st April to 31st March. And most companies also do their accounting in a similar way. But in Malaysia, it's generally calendar period. This is where you record all your expenses, your revenue, to see whether you get a profit or not. So it shows you your total income, your revenues. Sometimes they call it turnover. Turnover is another name for sales. Sales of business is known as turnover. Less cost incurred in making those sales. Why they are saying incurred in making those sales? Because it follows the matching principle of revenue should be matched against those expenses which were incurred to generate that revenue, right? So that's cost. So this is generally what happens when you prepare a P&L account. Income statement follows standard things, revenue, expenses. Expenses could be generally what happens in, this is for companies who are selling products, all right, who generate revenue by selling products or whatever. That's known as cost of goods sold, all right, those are expenses. You will have, if you're funding your business by loans or overdraft, you will have interest expense to pay for to the bank. And then you got selling expenses, a lot of selling expenses, general administrative expenses, which could fall into salaries, rental, stationery, and the whole works of it could be here, right? So once you get that, and then you'll come to something known as a depreciation expense. I will explain it separately. Bear with me for now, all right? What is a depreciation? We will look at that. And then you got income tax to pay. That is also an expense in your profit and loss statement, all right? So these are generally the type of expenses. And then you derive whether it's profits. Profits come in different form at different stages. The first calculation of profit, you compute your profit margin, which is your gross profit margin, the raw gross profit, which you derive from your business, all right? And then you have net operating income. Normally it's known as EBIT, interest before income, earnings before interest and tax. And then you have earnings before tax, that is known as EBT, all right? Generally, this is the corporate terms which are being used. In a business, like in your partnership, when your law firm, will be very straightforward. You got fees, and then you got lots of expenses which are related to generate the income down here, and then you got income tax or whatever. You have some, you derive some interest, you pay for some interest expense if you are funding your businesses. Typically, which is your biggest cost in your law firm, which is your business biggest cost? Partner salary?
I guess, and rental and things like that.
Rental, yeah. And then you got your associates who work for you or whoever, you got to pay those things. Any other big expenses which you incur typically in a law firm, other than salaries and rental?
Practitioners present tonight? Any answer? I'm not a practitioner.
What about loans that you
pay? If you take loans, you pay interest on loans. That is an expense. Loan, when you take a loan, it comes as a liability to your business. When you take up that liability, to fund that loan, you got to pay interest. That interest expense is charged to your profit statement. So there's not much of expenses in the law firm. You guys must be making a lot of money. Okay, all right. So the elements include revenues and gains. So as an income, you have fees which you receive from your client, you earn from your clients. Sometimes what happens is there are certain income you get in your business which is not coming from your normal ordinary activities, because your core of your business is to provide legal advice and charge your clients with legal fees. But sometimes you've got certain other kind of gains which you could take place in your business. If you have a property, which is your business property, if you sell the property and make a gain, that becomes a gain to the business, all right? I'm talking about business property, yeah? Not your personal property, your business property, and that becomes a gain. And it is also recorded as an income, but it is not from ordinary activities, because your normal activities is to charge clients with fees for legal advice. So you have, what are the different types of revenue? You could have sales, fees, you could place a lot of fixed deposits in the bank and earning interest revenue, or you could have bought shares in certain companies if you are allowed to in your business practice, and you will probably receive dividend revenue. Or in the case your business property, part of your property is being rented out to some other tenants, some other using part of your business property. If you receive rent, these are all incomes in your income stream in your company. Want to do a 5 minutes break, guys?
We can, yeah.
Okay, 5 minutes, all right, just to take the thing off, all right? Can you think of some questions you want and you can think of during this 5 minutes?
Actually, can I ask my question and you can answer it later? So what about if, like, say the property is my own property? See, I'm using my house as the as my law firm. How would that work, assuming there's some rental or whatever? It's my own house though.
So if you have your own house, it'll be tough to show any kind of rental expense because you don't have it as a rental. The only thing you can figure out of taking some cost, which could be in lieu of your business which you're running, is you may take some of your electricity cost and charge it out as an expense as part of the sharing, all right? You need to have some kind of a basis in case you get questioned by the revenue, all right? So those kind of expenses, water bills and all those things. But if rental, whether you want to charge anything for your house, even though you probably have your house under mortgage, assuming, and you must be paying interest expense to the mortgage, but I don't think they will allow you to charge that because it is a personal residence, despite the fact you're using. So you may want to find other ways of taking any of those expenses which are related to your property where you are using, and how much of that amount of electricity bill, water bills, all right, which could be appropriately charged to your as an expense in your business.
But Nakulan, the house is rented.
If it is rented, Mira, you can charge the rental, part of the rental, but the revenue will ask you, is your house fully used as an office or are you sleeping there? So you need to be
It's partial because
partial. You got to make some decision on how to allocate part of the house as part of your business premises. Say you're paying $10,000 rent, and say part out of the whole property, probably 1/3 of it is being used for as part of your business, and the rest of it is your personal housing. So you probably take 1/3 of your 10,000 and charge it out as an expense.
Yeah.
That's the only way you got to justify all these things.
Yeah.
It is going to be quite a common thing as people start working from home. There's more stuff which is going to come, and the revenue is going to be seeking for more information in this area.
Oh, Sheena has a question, Mr. Nakulan.
Sure.
Yeah. My question is, okay, I have my own place. I work out of my own place, right?
Yeah.
I own my place. I don't have a mortgage on it anymore or whatever.
Okay.
However, I pay maintenance fee because I live in an apartment.
Okay.
Can I apportion 1/3 of that maintenance fee?
Yes, you can. That's why anything which is related to your housing, electricity, water, and all these things, you provide justification of how much is the basis of allocation, and you can allocate it.
Okay. Thank you.
Okay. Even if you run from your home now, that's what I do. I mean, I do a lot of printing. I use a lot of printing, toner, ink, and all those type of things. You can take it as a business expense altogether, all those things, because you don't go to office anymore. And the amount of consumption of air conditioned electricity goes sky high now, I'm sure, for everybody. Okay, so all these things, you got to collect bills like this and keep it, because These are all related to the work from home kind of situation now. Okay?
Yeah.
Should we
Yep.
proceed?
Thank you.
Are we good to go?
Yeah, we can.
Yeah. Okay. The next thing is in the income statement, there are expenses, which includes both expenses and losses. Typically, you have those expenses, which is ordinary activities, your business, your rental, your payment, your expenses related to your counsel and your partner's salaries and all those kind of typical expenses there. Sometimes you might have certain losses which comes about not from ordinary activities. Like the example I gave you earlier, if you have a business property, you sold it and you made a gain, it comes as an income. If you made a loss, it will come as a loss because your sale of your property is not a normal activity in your business. You are not in the business of selling property, but you're in the business of giving legal advice. All right. That is ordinary activity. That is losses may be from those kind of things. So typically in your expense account, you'll have cost of goods sold, which is for those companies which make products and sell products, depreciation expense, which I'll come to it, interest expense when you take loans for your business, rent expense and salary expense. This is not exhaustive, guys. All right, I'm just giving you a kind of some of the key items which as a charge in the business as a expense. Coming to depreciation, or it is also called amortization. You guys buy computers to be used in the home now?
Yeah.
A lot of stuff. Internet bills. I mean, internet bills are already in the ambit of part of those tax deductions which they give you for internet and telephone use and all those things. Depreciation is amortization, is a process of computing expense from allocating the cost of fixed asset over their economical useful life. Now, just to go back, if you, in a business, if you buy a motor car, like the earlier example I had, if you buy a motor car for 100,000, it is a fixed asset. That's for business. You're buying a motor car for your business use, it's 100,000. So what you cannot do is you cannot take the 100,000 and charge it to your income statement as an expense, a one-time expense, because this is a fixed asset, which is a capital expenditure. This motor car is going to serve you for a period which will be called economical useful life. Typically, they use about 5 years as the life of the motor car on average. You might be driving the motor car for 20 years, irrespective, but the life of typically they use a 5-year period. So what do they do is they take the 100,000, divide it by 5. Every year to the P&L, they charge 20,000, 20,000, 20,000 as a business expense. Why? It is typically following the matching principle. That motor car is being used in your business to generate revenue over a period of 5 years. That's really the matching principle. So fixed assets will wear over time. That's why earlier we had some word called book value. What do you mean by book value? If you buy a motor car for 100,000 ringgit, the first year the depreciation is 20,000 ringgit, you will charge 20,000 off to the profit and loss account. The value of your motor car will be called book value, which will be 80,000 ringgit. Subsequent year, again, it'll go down by 20,000. That's why it'll call book value. It is not the net realizable value. It is the book value as is recorded in the balance sheet. Yeah. For example, here we have 4 notebooks. You bought these 4 notebooks for 20,000 ringgit. The useful life you have taken an assumption is going to last you for 5 years. All right. Sometimes they use 3 years because the way how fast technological advances are taking place, they usually keep the economical useful life 3 years, normally for computers and software. But I'm just using for this example 5 years. So what happens if you use a straight line depreciation method? You take the 20,000 divided by 5 years. Every year you charge 4,000 as an expense to your P&L.
So Nakulan, Zen from Anton and Chen has a question.
Sure.
Is the motor car that you talked about, does it have to be registered under the partnership? Because I don't think a motor car can be registered.
Why not? Is it? Why is it? It is not a vehicle to be used in the business. It cannot be, is it?
Because sorry, but my question is that if So let's say if the car is registered under the partner's name,
Oh,
would
no,
that be, yeah,
no, it won't be allowed.
right. So it has to be registered under the partnership.
Partnership, yeah, it is. If it is an individual partner under the partner's name, no. The only thing which you can relate and collect certain things as deductible expense, if you go and provide toll tickets and mileage claims and whatever petrol bills and whatnot to the company to make a claim that you, this part of your, it is expenses deemed to have been incurred in terms to generate revenue. Maybe you're running up the court, the client or whatever and all those things. But anything to do with that particular asset, it is yours, unless it has been registered with the firm. Okay.
All right.
So that's really depreciation, all right? This is how depreciation works. And at the end of the day, it is the rule of the game is it is a fixed asset. It cannot be charged to the P&L. It will be charged over a period of time by the way, something called depreciation or amortization. Same thing for patents and goodwills, which companies will record if they have patents and goodwill, which they bought a business at a higher price. They record it in the business accounts as called intangible assets, goodwills or patents. So what they do with the patents and goodwill, they will probably amortize it over 20 years, a longer period, because those things will be charged over a longer period of time, patents and goodwill. You guys involved in patent, legal guys are all involved in patents, right? So those type of things. So income statement, what goes into the income statement, just a recap, the money a business takes during the reporting period, what are the expenses you incur, and cost of goods sold, which is typically for companies who are selling products. And gross profit is the first line of profit, which you get, the cost of making that product and the revenue you get in generating that, the income. Then you have operating income coming in, all right, which is gross profit less all kind of operating expenses. Then you got your interest expense, and then you got income before income taxes. You will have to be paying taxes. After paying your taxes, you will have net income, which is normally called net profit. That's how it is. All right. It's all wordy here. The next slide, you'll have numbers. So that will be a bit more easier to understand as you go through. So same thing. This is the same thing, but the format falls in this way. You start from the top line. You know, everybody, the accountants have a very, very fond of saying the top line of the company is this, the bottom line of the company is this. Top line of the company is the first line in your profit statement, which is your revenue or your sales. The bottom line of the company is your net profit, which is your net income. That's what bottom line and top line means in their own words.
So Nakulan, Yunwai has a question. How would disbursements recovered from clients be recorded?
Come again?
My phone.
Disbursement?
How would disbursements recovered from clients be recorded? Where do they go?
Now, when you incur those disbursements, all right, you will be charging it in your expense line. Okay, and then what you do is you will have fees collected from your clients, all right, which will go into the fees line, and then there's a recovery of those disbursement, which will have to be going back to your expense line to reduce those expenses because you have recovered those expenses. So if, say, for instance, you got a if you got an expense, say, for instance, traveling, printing or whatever, say it's 100 ringgit, but you recovered from your client 80 ringgit or something like that. So you will take the 80 ringgit, knock it out against your actual expense of 100 ringgit, and you have a net expense of 20 ringgit if you're not recovering enough. But typically you'll recover more than that, I'm sure.
Such confidence. Okay.
All right, that's what happens because it is not supposed to come as a fee. It is not fees. It is recovery of disbursement. Okay. All right. So let's look at this income line. Huh? Assume I put a few numbers to it. Sales revenue is 800,000, and then you have cost of sales, the cost of making those products, 300. You less that, and this is where you come to something called gross profit. This is like the gross margin of the company. Then you list out all kind of expenses, sales and administrative expenses, all kind of operating expenses. Then you come to something called operating profit. Once you get your operating profit, there is further expenses to come by. Financing costs. What is financing cost? Is interest expense. You take loans from a bank, you pay for overdraft interest or whatever, you charge it as at this line here. Then you have something called pre-tax profit. After charging all these things, this is the amount of profit. This is the amount of profits which will be attracting tax. Assuming your tax is 20% for the purpose of this question. All right. So your pre-tax profit is 350,000. Assuming your tax rate is 20% on your pre-tax profit of 350, you have to have an income tax expense of 70,000. So your net profit after tax is 280,000. And then what happens is, this is in partnership, you don't have dividends, but in a company, they declare dividends. So whatever profits which comes after tax, which are typically, I think lawyers will know this name, distributable profits. Is it something familiar to you guys? Company law, you guys did, right? No, it's distributable profits. So from the distributable profits, you will pay out your dividends. After paying out your dividends, you are left over still with profits. So what you will do with this profit, the word suggests retained profit, you will plow this profit back into the business. So this is a typical format of how a profit and loss account works. From the right and from the top line, how it gets into the bottom line, which is your pre-tax profit, after-tax profit, and you pay your dividends and you got your retained profits. This is the format.
Okay.
Okay, so now you have this format. You guys have seen this. So what I want you to do quickly in 5 minutes, you should be able to do it. All right, have a paper and a pencil available beside you and a calculator. I have scrambled all this information up. This is some information of a particular company. All right, for the year ended 31st December 2020, they have an interest expense of 80,000. Cost of goods sold of 400,000, operating expenses of 200,000, revenue of 2 million, tax of 220,000. What I want you to do is put all this scrambled information into this format. I mean, this is no rocket science, guys. This is something you have done. It's just to follow the format to get the thing flowing to you is what goes first, what goes second, what goes third, or whatever. So what I do is I keep this format open here for you to view. Okay, can you start now?
Okay, while the rest of them are using their brains, I have a question.
Sure.
So what about bonuses? Do they come like after, at the point of your profit after tax, or is that an expense that comes in early?
It is an expense. So what management accounts they do is usually they'll calculate all your profits, and then if you're under profit sharing situation, all right, you want to for your is it for your employee or the partners or who?
Either way.
Either way, normally in management account, they calculate what will be the profits of the company. From the profits of the company, they calculate what is the bonuses. Once they decide on the bonus will go up as an expense again.
Oh.
So usually they will calculate it using management accounts to see what is the profitability of the company or your firm, and then calculate the bonuses. Once they calculate and say, this is the amount of bonuses which you are going to pay, they will charge it into the expense line, and then it comes, and then you calculate your tax after that.
Okay.
5 minutes, huh?
Everybody, please try.
Try. Just put it in just write down sales. How much is sales? How much is cost of goods sold? Minus that gives you gross profit, just to get a bit of a hang on this.
Oh, yo, that's fast.
And who's that?
It's the Rajeshri Spriyash, 1,100,000 bottom line.
Oh, that's great, man. I think the second session you can take over.
Yeah.
That's good, very good. I mean, the whole thing is, it's not really a formula or whatever. It's just a way of calculating things and putting, just to get the format, what comes first, what comes second, whatever.
You are going to give us the answer though, right? Just checking.
Oh, yeah, of course.
She said, your explanations are clear and brilliant, Mr. Nakulan.
Is it? Okay.
That's what Rajeshri said.
Thank you. Mira, you done?
Yeah. Yeah.
I am not partaking in this. I will fail.
That's okay. You can try, just put them in the right boxes.
Oh, Kiran says she agrees with Rajeshri, 1.1 mil.
Okay, rest of you guys, you got it, 1.1 mil? You want me to get to the answers, guys? Yeah?
She says yes. Yes.
All right, so if you got this, that's really what happens, all right? Just putting it in the specific. The whole intent down here is just to make sure that you understand what is your top line, what is your bottom line, what are the things comes in, and what is the sequence it goes. So nothing comes, your tax will be after charging all expenses, but in reality, this is for the purpose of this illustration, but in reality, when they calculate taxable profits, there are various other things to add and minus and all those things. That's a tax computation, which is a separate thing altogether. But just this, for simplicity's sake, this is how it goes.
Okay.
Okay, good. All right, the next item is balance sheet. All right, the word itself suggests it has to balance. If it doesn't balance, nobody goes home from work. All right, that's what happens normally, typically in accounting roles. So we'll look at the major classification of balance sheet, what are reported and what not. Okay, so the balance sheet here is assets. All right, so assets must equal to liability and equity, as you see in the small picture there. It has to balance. It has to balance. All right. So balance sheet provides a snapshot. Income statement is for a period, which is typically 12 months. Balance sheet is at the end of that period, which is typically a snapshot of the company or your firm, indicating what is the assets, what is the value, what the firm owns, what are the value of the firm's debts, how much of debts they have, which is liabilities, and shareholders' equity, which is the capital, money invested by the company or the owners of the company. That's typically what the balance sheet will do. Provides a snapshot. It is defined by the equation. This standard equation comes into the balance sheet. Assets will be one side, being funded by, how did you fund your assets? You either borrowed money to fund it, or you put capital in your company to fund the assets. That's how the whole thing works. When you start a business, you have to fund your business by injecting your own money or borrowing money. So one side is borrowings, one side is capital. That's what it means. So what are the assets you'll have in your balance sheet? Current assets and fixed assets. We'll be looking at what current assets and fixed assets are. And what are the funding, sources of funding? Current liabilities, long-term liabilities, or owner's equity, which is your capital, right? So assets are being funded by these three items, which are liabilities, long-term or short-term, which is current liabilities, and owner's equity. Current assets are those assets of a firm is cash plus all other assets the firm expects to convert to cash within 12 months or less. Typically, they are receivables. When you bill your client, the client owes you money, has not paid you yet. It sits in your balance sheet as a current receivable from your client owing you money. And in a company where they sell products, they will have inventory. Inventory means stocks, putting in the warehouse, the stocks there which they have made but haven't sold yet. Those are current assets. Why they are known as current? Because they can be converted normally within a period of 12 months into cash. inventory, you take the inventory, you sell it, then you becomes receivable, and then you collect cash later. So they are convertible. When you bill your customer or your client, you invoice your client, that will be sitting in your current assets. And whatever money you have in your bank, short-term deposits or bank balances, they're all current assets. Fixed assets are of a different nature. Like just now in the example I told you, if you buy a motor car for your company or your firm, that is a fixed asset. It's of a fixed nature. It is not going to be converted because it is usually there will be there for a period of 5 years, which will be the economical useful life, property, plant, or whatever which you have. Those are fixed assets. So two types of assets. One is fixed, the other one is current.
Mr. Nakulan,
Yep.
what about, okay, so in law firms, they have like these rentals, like photostat machines and stuff, right? Where would that sit?
Leasing, is it?
Yeah, like they have like long-term leasing for photostat machines.
Yeah, so I will come to one area later, but I can talk about it now. In terms of leasing, there are two types of leasing. One is known as operating leases. Typically, all these photostat machines and all these things where you don't get yourself bothered about what happens to the photostat machine. Anything goes wrong, the vendor will come there, repair the photostat machine, and then you will have, if there are repairs, the only thing you might be charged on is the number of prints you do and whatnot.
Yeah.
You'll be charged. The ownership of that photostat machine is not yours. So that's known as an operating lease. So whatever you pay for your operating lease will be charged off as an expense in your P&L as like a rental.
Okay.
On the other side, you have financial lease. Financial lease is where you will take ownership of the property or the machine or the car or whatever at the end of the tenure of the period where you settle your loan or whatever. A typical example of financial lease is like what you do in a hire purchase agreement. So when you do have financial lease, only the interest portion of it can be charged to the P&L. Not the principal sum, because the principal sum is going into as fixed assets. Where that's why a lot of companies, a lot of businesses prefer to go into operating lease, because no hassles, not bothered about repairs, and you don't want to have ownership of the asset at all. All right, you just want to charge it off the expense and move on.
Okay.
Okay. Current liabilities are those which are the firm owes. Typically, current liabilities are those money you owe to your creditors, your suppliers, and all, which needs to be paid within 12 months. Normally, tax liabilities need to be settled. All right, you have your settlement period, which has been prescribed by the revenue department. Long-term liabilities are of a longer nature. All right, those are if you take bank loans or you issue bonds, right, attracting crowdfunding, you borrowing money and all. Those are long-term liabilities, which will be having a maturity period more than a year. Stockholders' equity is your capital, which is the amount of money received from selling shares to your investors or your partners bringing money into your business, which is a capital. And remember, after all your profit, you derive all your profit, you pay off your dividends, you still got leftover profits. Those leftover profits are plowed into your business back again to drive growth in your business, which is called retained earnings, which will increase your equity of your company. Right? So again, standard, all right, you'll drill through this thing already. You cannot forget for life, I'm sure, right? Assets equals to liabilities plus equity. And you got to turn it the other way around, all right? So what is assets minus liabilities?
Capital, equity.
Huh?
Equity.
Okay. Asset minus equity?
Liability.
Liabilities.
Okay. If you don't have liabilities in your company at all, then assets is equal to equity. Right? Simple as that. But generally, later when we do in the second session next week, we'll see how do you mix, how do you capital structure your company accordingly to make sure that you optimize the cost. Okay? Okay, balance sheet. You have cash, you got accounts receivable and land. I grouped it together as total assets of this particular business, right? And part of it is current asset, part of it is fixed assets. Then you got liabilities, accounts payable and other payables, 200. And then you got owner's equity, which is capital, stock, they call it, or capital. Retained earnings is the money which you put back in your business, 140. So total liabilities and total equity is 340. Both of this must equal always. Then only the balance sheet will balance. So this is how the accounting equation works. If you look at the accounting equation, assets is 340, your liability is 200. 340 minus 200 gives you 140. Correct? 340 minus 140 gives you 200, which is your liabilities. All right, this is the typical accounting equation, which translates itself into a balance sheet. Okay.
Is there any if the liability is way higher than everything else, then apart from concluding that they are working at a loss?
Yeah, you could have, it'll eat up into your capital. You'll be having a deficit situation. So if liability is very high, what happens, you can have, you see what happens is, you can have liability of 500 or so.
Mm-hmm.
And your equity could be 50 or whatever. So 500 plus 50, you must have assets this side of 550 anyway. Whatever happens, it is a balancing thing, all right? It has the impact. Remember, we went through by each transaction, everything needs to hit one of those things, one of those elements. So what is the usefulness of a balance sheet? You evaluate the capital structure of your company or your firm. You can understand the risk involved, because you look at the balance sheet, you look at your debts are very high, your owings are so much, and all these things. It gives you an indication, the solvency of the company or your business and the financial health of your business. It gives you a good indication of it. Okay, this is the format. I'm giving you a simple format. This must equal to each other. All right, I put all the fixed assets, total assets minus current liabilities, which I call it net assets in this case. So assets minus liability equal to equity, right? Remember, yes, now. All right, so I'm just putting certain items inside here, okay, with certain long-term liabilities, which I'm putting it into this line here. Whichever line you put also, you'll still have to balance. Using this format, I got a question. Same like yes, now, 5 minutes. You got all these items here: property, cash, computers, accounts receivable, long-term liabilities, equity, inventory. Inventory is like stocks, is a current asset item. Accounts payable is a liability. So if you use this format, same format I'll give you. I'll put it into one pager. Fix the numbers. 6 minutes, 1 minute more than earlier. All right, guys, give a try, please. Just put it in the right places. There are some fixed assets. You know what are fixed assets. All right, look at it very closely. What are those fixed assets? What are those things which falls into current assets? You must identify and add them up together and put it into current assets. And then you've got to find out what is current liabilities in this case here. And then you'll get something called net assets. And then you fix your numbers for equity or share capital. And then long-term liabilities. Do you have long-term liabilities in this question? You put it there and see what happens, total liabilities and equity. Got it?
Okay, if anyone has balanced this, now's the time to share. Right? I'm also not balancing it now. Why?
You know, you can imagine how the accountant's life would have been about 50 years ago when there were no computers. They had to manually record it down in their ledger and all, and then they never got it balanced because something went wrong somewhere. And then they have to sit in their office for hours trying to balance it. And then if it doesn't balance, we'll just put a balancing figure and go home.
We also have sad stories to tell you, Nakulan.
I know. What's the total?
I'm getting something like 3,450, but then it, obviously the other side is not balancing. I have an additional $50 that's knocking around. Are you feeling generous and wanting to give us the answer already?
Okay. You got this? What's the equity? Hang on. Sorry. Sorry, there's a mistake here. Yeah. You got how much?
I got 3,450. I'm pretty sure.
Your long-term liabilities and equity is 5,500. I think the numbers were wrong. Sorry, there's a mistake in this number. Sorry about it. What did you get your net assets as? Your fixed asset is 3,000 plus your computer 3,150, correct? And then you had your accounts receivable and your inventories.
4,150.
Accounts receivable is 800, inventory is 1,300, is 2,100. 1 minute, huh? I think because I changed the question the other day, I probably added up wrongly.
Okay, now I don't feel so bad.
I know. Accountants can make mistakes too, all right? So you have 1,500 in cash. Computers is 150. Sorry about it. Minus plus 800 is your accounts receivable. Minus your accounts pay. Inventory is 1,300. 4,150 minus your accounts payable. The question is wrong, guys. Sorry about it. I'll fix it and send it to you separately. Sorry about it. It is not a trick. Sorry. That the intent was to put the balances in because one of the figures has been wrong, so it doesn't balance. You didn't balance it?
No, it just reinforced my belief that I can't count to save my life.
No. If you didn't balance it, it's very good. If you had balanced it, there must be something wrong.
Okay.
Okay. Sorry about it, guys. No, all right. Yeah, I'll send you the answers because I'll send you these separately. Something went wrong with this thing. The equity is not 3,750. I picked up the wrong number. All right. Sorry about it. Okay. The last statement which we'll be doing down here is not doing an example on it, but it is a financial statement, which is your cash flow statement. It tells you the timing and the uncertainties of cash flow. Remember, profit is not equal to cash. Why is not equal to cash? If you bill your customer, you show it as an income stream in your business. It is not the time when the customer or your client pays you. Both things comes at different timings, all right? So the question you ask yourself sometimes is, why is that I got a lot of profits, but I don't have money in the bank? Why? Because probably what happened is your collection period is 70 or 100 days. Your client is not paying you, but you recognize as an income in your P&L. On top of it, you've taken some of your money and bought fixed assets. a lot of fixed assets. You bought a motor car and all, your bank is at a deficit at the moment, despite the fact you have made profits. So a cash flow statement will tell you what is really happened to your money from the beginning of the year to the end of the year. What are the changes which have taken place? And it shows you what cash you receive, how you spend that money. Because cash received and what is being spent is not equal to income and expenses, because they follow a different accounting concept of revenue recognition, matching concept. Cash is actual money coming and money going out of the business. So the statement provides the answers for where did the cash come from, what was the cash used for, and what is the change in the cash balance. That's the statement of cash flow statements. I won't get into a detailed example on this, but just for you to know that the fact that there is something like a cash flow statement, because a P&L doesn't explain why the answers to the why do you have so little cash despite making so much of profits, or why do you have so much of cash despite making losses. Could be that you have sold some property and brought the money into your business. This different things could have happened. So a cash flow statement, the thing is, it will show different activities. How much of money came from operating activities? How much of money came from investing activities, like you have bought shares in companies or whatever, how much of dividends you have got from there, and how much of monies are involved in financing activities. If you have taken loan, money would have come into your business. You have paid interest, money would have gone out of a business. So this tells you a different story altogether compared to a profit and loss account. It is actually what the cash flow statement trying to do is trying to tie up the pieces. Why profit but no money? Why loss? There's still a lot of money in the company or the business. That's it tells you that story. All right. Don't worry about the format. It's just to understand there exists a statement like this. Okay.
Okay.
Good. A quick one. 1 minute, I got to do something here. Just a 5 minutes thing, which puts. You hear?
Welcome back to New Venture Mentor. I'm Kate Costa, and today we're remaking one of my most popular old videos, the 5-minute finance lesson, covering the basics of understanding your financial statements. If this is your first time here at New Venture Mentor, be sure to subscribe and join the thousands of entrepreneurs I've helped to launch and grow their businesses, and be the first to know every time I add a new video. One of the biggest issues I see with entrepreneurs, no matter how big or small their business, is that they don't have a grasp on their financials. If you don't have an accountant, you clearly need to have at least a basic grasp of how to manage your business's financial health. And if you do have an accountant, you need to understand what she gives you and be able to have an informed conversation with her about your business's financial performance and where improvements need to be made. Now, is all of that going to happen in a 5-minute finance lesson? Obviously not. But at least you can get a basic understanding of the 3 main financial statements: the balance sheet, income statement, and statement of cash flows, and what each means for understanding your business. The first financial statement that you'll need to know about is the balance sheet. The balance sheet shows the company's assets, liabilities, and shareholders' equity as of a specific date. Its assets are split into current assets, which includes liquid assets such as cash and accounts receivable, and property, plant, and equipment, which are less liquid assets such as land, buildings, and obviously equipment. Liabilities are also split into current liabilities and long-term liabilities. Current liabilities are those due within the next year, while long-term liabilities are those due in over a year. So, for example, if you have a mortgage, the portion of the mortgage that is due within the next 12 months would be counted under current liabilities, and the rest of that mortgage would be counted under long-term liabilities. The total assets and total liabilities plus shareholders' equity must equal each other. So, if you create a balance sheet and those two numbers don't match, you've made a mistake somewhere and you need to go back and check your work. The second financial statement that you'll need to learn is the income statement, also known as the profit and loss statement. The income statement shows a company's profit or loss over a specified period of time, and it shows revenue and expenses split into operating and non-operating income. Operating income starts with sales and cost of goods sold to give the gross profit margin. It then deducts operating expenses split into selling expenses and general and administrative expenses. Selling expenses are those expenses directly related to sales and would include things like sales commissions for your salespeople. Administrative expenses include the costs of running the business that are not directly related to sales, such as office supplies and utilities. The gross profit minus your operating expenses gives you your operating income, and then you add or subtract the non-operating income such as interest to get your net income. The final financial statement that you'll need to learn is the statement of cash flows. The statement of cash flows is vitally important, as many small businesses fail not because of profitability issues, but because of cash flow issues. The statement of cash flows shows a company's inflow and outflow of cash over a specified period of time. The cash flow statement is broken into cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. For cash flows from operating activities, you start with the net income, and then you adjust for non-cash revenue and expenses such as depreciation, accounts receivable, and accounts payable. For cash flows from investing activities, you include things like the sale of a factory or building or equipment. And finally, for cash flows from financing activities, you'll include things like the sale or purchase of stock or distribution of dividends. This gives you your net increase in cash. Add that to the cash you had at the beginning of the period, and you'll know how much cash you have on hand and available now. Now that you understand the very basics of these three financial statements, you'll better understand how your company is performing so that you can strategize for future growth. If you need a bit more info, which you will, I have some old school New Venture Mentor videos linked to in the description below the video that will give a bit more background on each of these financial statements separately. That's it for this week. If you liked this video, remember to share and subscribe so you'll never miss the latest tips.
Okay. All right, now we got a small learning assessment. Can I share it on the chat group, the question?
Yeah.
To everyone?
Yeah.
It has 8 questions. 1 minute. Oh, sorry. Wait 1 minute. Have you got it? Yeah, your PDF document, I will send it to Shanti, and I think she'll mail it to you for today's lessons. Is it okay?
Yeah.
Only if we already have their email addresses, Nakulan.
Okay,
So-
you're giving me?
So for those of you who haven't shared your email addresses or you got onto this event because you got access to the link, could you just drop your email address in the chat box so that we can send this to you?
Okay, I will send it to you tomorrow after making a revision to what, remember the question is now?
Yes.
Okay, I will do that. Yeah, please. Yeah, I will do that because I will share it after that. Okay, learning assessment, it's 9:48. You got 8 minutes. Okay, 8 questions only. Everybody can look at the question. You can just jot it down. Number 1 is A, number 2, B, or whatever, and record it in your own papers. And then you can do a self-assessment when I go through the answers after this.
Sure. Are you sharing the answers with us now?
Yeah, if you're done, are you guys done? Or at least 75% of it, or all of them?
Done.
Okay. You want me to share the answers?
Can.
Okay. The first one, what is it? Which is not a liability?
B. Accounts receivable.
Correct.
B.
All right. All right, great. What's the next one? Assets total 50, liabilities 10. What's equity?
B.
Hey, great. All right, fantastic. The financial position of a business on a given date is reported on what?
Income.
Balance sheet. I don't know.
Profit income statement is for a period. Balance sheet is at a point of time,
Balance sheet.
at a given date. Financial position at a given date. Okay. Investment of cash into the business result in what?
B.
Decrease in cash.
Investment of cash into the business. When you bring, when you start your business, you bring cash into your business, what happens? You're bringing it as capital, right?
Increase in cash and
Cash
increase
and
in
increase
capital.
in capital.
B.
Yeah. All the answers are B.
Yeah.
Okay. Keeping the records of business separate from personal records of the owner is what?
B.
What B. If during the accounting period the assets increased by 7,000 and the owner's equity decreased by 3,000, then the liabilities must have what? Just put the equation of asset equals to liability plus capital on your piece of paper. And then what you have the question, asset has gone up by 7,000, positive, gone up by 7,000. And then what it says, the equity decreased by 3,000, went down by 3,000. Then what would have happened?
B.
Any other answers? A, liabilities must have increased by 10,000, because how did you get your assets? You put your equation and see, put on the piece of paper and see how it works. For this, capital has gone down by 3, liabilities must have gone up by 10. 10 minus 3 must have given the impact of the increase in 7 in assets. Okay. During the accounting period, assets increased by 5,000 and the owner's equity increased by 1,000. Then the liabilities must have, what would have happened to the liabilities? Same way you put in a piece of paper, all right? So what it says is assets increased by 5, so went up by 5. Then it says owner's equity increased by 1,000, went up by 1,000. For this to happen, what has happened to your liabilities?
Decreased by 4,000.
Increased by 4,000.
Increase. Oh, oh yeah. Yeah.
Because you need, if your asset want to go, you see, the whole idea here is your assets of your company can be either funded by equity or liability, two aspects.
Yeah.
Financial statement keeps track of inflow of outflow of cash is called what?
D.
Statement of cash flow. Remember, guys, we just did it. Shows what money comes in, what money goes out. Okay. Kind of on the dot. You're done for the day. Shanti, I will send all the stuff to you guys, the PDF copies, and yep, I will send you the answers too for this question and the other question. Any questions, guys? Anything? I mean, something to do with anything with your business or practice which you could relate to today? Anything specific which I'll try to answer if it's not very complex.
No questions, but Sheena says this is very entertaining and informative. Yes, thank you.
Entertaining because I made a mistake. That could have been very entertaining. I'm sorry about that. I changed. Actually, the last week when we went through the dry run, I had these numbers which were huge. I tried to reduce it, and then I think there was a bit of an oversight or something. All right. So that's okay. Sorry about it.
It's okay. Just to let everyone know that you have another chance to be entertained next week on the 12th of October at the same time, 8 p.m. So if you want to attend, then please register on PTIX like you already did for this one.
Yeah.
And then we can see you again next week. And that's going to be more about corporate.
Yeah, it's more corporate finance. It's more about capital structuring. Those who are in corporate, I mean, doing some corporate work, looking at fundamentals of business valuation and whatnot. Today, we went through the very basic 101 of fundamental accounting principle. Next week will be a bit more complex, looking at various terminologies, ratios, and whatnot. Okay.
And in case you don't know, Mr. Nakulan, you've got 100% marks from one of our participants. So that's an A star for you right there. Thank you.
Thank you. Thank you.
Thanks,
And, okay, guys, I'll send you take some time to read. I mean, you can read so much. Google anything you can find. All right. Just if you're not sure of something you went through today, you just Google the word out and you can read about it. All right.
We can Google you too.
Yeah.
It's not the same as when you have someone who explains it.
I know. It's true.
And I'm very, very grateful for that.
But you know something? There's so much information on YouTube. Unbelievable. All right. If you want to find out a bit more of things, there was really good ones which was 20 minutes, but I thought it'll take too much of time. I just look at 5 minutes clips or 4 minute clips. So that's it.
Important thing was that people asked questions that you were able to answer. So those personalized bits of attention was really useful. So thank you. And one of our participants today is from Kota Kinabalu. So she's tuned in especially to hear you tonight. So the reach is far, Nakulan.
Yeah, I know the witch can go any part of the world.
Absolutely.
Okay.
Thanks a lot, Nakulan.
Okay,
Thank you
thanks,
very
guys. Have a
much.
good day.
Sheila,
I'll see
Good
you next
night.
week.
Thank,
Good night. Cheers.
Sheila, you want to wrap
Night.
up? Thank you.
Yes,
Thanks,
thank you everyone for joining us. Of course, Mr. Nakulan, super fantastic. We're looking forward to 12th of October. All of you, if you enjoyed yourself, make sure you show up on the 12th of October and get your friends to register on ethics as well. And yeah, tell everybody that we have a great session coming up on the 12th, same time as tonight.
Okay.
Thank
Good
you so
night.
much for joining us, everyone.
Right.
Okay, bye.
All right.
Night.
Bye.
Thank you.
Bye.
Thanks, Sheila. It was really good.
Yeah, Mr. Nakulan, the job is made easier.
Isn't it so entertaining as well? Yeah. Okay, you have a good evening and rest. I know you are working again tomorrow. Thank you.
Okay, good night.
Good night, everyone. Bye.